good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, we are in the very final week towards that very blessed Christmas holiday, but of course, markets move on, and today we're taking a look once again at the banking sector with recently released earnings, and we're looking at Canadian-owned banks today. We're talking, of course, about CIBC FirstCaribbean, as well as Scotiabank, Trinidad and Tobago. Now, both banking groups would have reported improved earnings with some fairly similar trends. Let's take a look at what would have happened and what investors can expect in the months ahead. Turning very quickly to Scotiabank, Trinidad and Tobago, SBTT, and for that fiscal 2021 period, Scotia would have reported an earnings per share figure of $3.42, which was a 16% increase from the $2.95 reported in that prior comparable period of fiscal 2020. Net interest income actually declined 7% from 1.3 billion to just about 1.22 billion. Overall, however, total revenues declined just around 2.7% from 1.78 billion to 1.73. There was an improvement in non-interest expenses, meaning that non-interest expenses actually came in a bit lower. There was a very significant reduction in impairment losses on financial assets, falling from 229 million to just around 108 million, which is a 52% decline, and that would have contributed in a very significant way to an income after tax of $603 million for the stock, compared to the 521 million in that prior comparable period. When we take a look at the revenue story, it continues to be a trend of declining revenues over the past 2 fiscal years. We can see that despite a 10% bounce in other income, which includes fees and commissions from 465 million to 511 million, it was not enough to stave off overall decline, and as mentioned, that 7.2% decline in net interest income from 1.3 billion to 1.22 billion. So we can see following a 4% decrease in revenues year on year in fiscal 2020, that revenue trend has continued with a 3% decline in total revenues over fiscal 2021 versus fiscal 2020, again largely attributable to that fairly significant decline in net interest income. Now, from a valuation perspective, Scotiabank has retained a fairly stable stock price over the past couple of years, notwithstanding COVID, but that has come at the cost of elevated valuations. As we can see, earnings in fiscal 2020 would have dipped from $3.79 in fiscal 2019 to fiscal 2020 to $2.95. With that rebound, despite that rebound in earnings, its price earnings ratio has, based on that green line, trended upward to just around 20 times level, which is somewhat elevated from its typically historical level of around that 16 to 17 times in, let's call it more normalized periods from fiscal 2017 to fiscal 2019. And investors will, of course, be keeping an eye on these elevated valuations, notwithstanding that they have been occurring across the entire market. Now, at the price of $68.50, Scotia is trading again at that price earnings ratio of 20 times, in line with the current banking sector multiple of 20 odd times. Again, historically, banking sector multiple averages have been quite inflated in the past 1 or 2 fiscal periods. And Scotia does offer investors a trailing dividend yield of 5.1%, which is quite healthy relative to the banking sector average of 2.4%. Now, with that increased operational efficiency, those consistent dividend payments, fair valuations relative to current banking sector multiples, but again, elevated relative to its own historical levels, Bourse is going to maintain a neutral rating on Scotia for the time being. Turning very quickly to FirstCaribbean, well, the banking group would have recorded earnings per share figure of 52 cents, which is a very significant improvement from that loss per share of 68 cents TT dollar equivalent in the prior comparable period of fiscal 2020. Again, very similar trends, revenues down just around 2.6% when we look at 3.7 billion TT equivalent in fiscal 2020 to 3.6 billion in fiscal 2021. Again, the major change here was that there was a fairly significant decrease in credit loss expenses on financial assets, falling from 1 billion in fiscal 2020 to just around 100 million in fiscal 2021, and no impairment of intangible assets, making that income to attributable to equity holders swing from a loss of 1 billion in that fiscal 2020 period to 824 TT equivalent in million in fiscal 2021. Again, fairly similar trends on the revenue side for FCI. Net interest income did decline 5% odd. We have seen a fairly significant, a fairly modest improvement rather in operating income, otherwise just about a 3% increase from 1.15 to 1.18 odd billion dollars. And from a valuation perspective, FCI is actually trending pretty close from a price to earnings perspective at 11.8 times, which is on an adjusted basis fairly comparable with its historical trends through fiscal 2017 to 2019. Fiscal 2020, of course, an anomaly with some of those very significant impairments and credit losses. At a price of $6.15, again, FCI is trading at that 11.8 times multiple, which on the face of it appears fairly attractive again to the current banking sector multiple, but investors would certainly have one eye on that unsuccessful bid by the Gilinski Group to acquire just about 2/3 of FCI way back when, it feels like almost 2 years ago, in fact, which would have taken place at a market-to-book level of 1 time and certainly would be fairly elevated, fairly at a discount relative to current prices. So with lower credit loss provisions, stabilizing financial markets, and take that with a grain of salt because financial markets have been wobbling in recent times, and certainly this morning, market futures suggest that there will be some downward movement, and overlaid with that economic uncertainty, Bourse is going to maintain its neutral rating on FirstCaribbean as CIBC FirstCaribbean for the time being. Well, that's it for this week's edition. And on behalf of our entire team at Bourse, we want to take this opportunity to wish you and your family a very safe, blessed, and healthy Christmas season. And we'll see you next time on the Bourse Report.